Hello friends, hope you're doing well. Chris Lee, CPA here, back with another video. So today we're going to talk about year-end 2025 last-minute general business tax deductions you can work and implement at the end of tax year 2025. So idea of this video is to give you 6 strategies you can easily understand and implement before the year end. So with that, let's go ahead and get into it. So the first strategy is going to be prepaying expenses under the IRS safe harbor rule. So the IRS has a particular safe harbor that allows cash basis taxpayers to prepay and deduct qualifying expenses immediately upon payment. So not necessarily when you receive the benefit of the services that you're buying or whatnot. So under the safe harbor, you make 2025 prepayments and for 2026 services or insurance policies or whatnot, and you deduct the payment in 2025 when you paid it rather than in 2026 when you receive the benefit. So the important rule here is that you must prepay only 12 months of qualifying expenses. So if you're prepaying into 2026, none of those expenses can be a benefit related to tax year 2027. So you have a 12-month of qualifying expenses. So the most common example of this is maybe an insurance policy. So say you're going to buy your tax year 2026 insurance policy, liability insurance or maybe a business vehicle insurance policy, and you're going to prepay that December 2025. Most policies are 12 months, so you'll be able to claim that deduction up front. So an example of this, so imagine you have some insurance policy that's costing you maybe $1,000 a month of insurance. And so rather than paying it monthly over 2026, you're going to pay all $12,000, the $1,000 for each month of 2026 on December 31st, 2025. So you pay $12,000 to cover all of your 2026 insurance. General rules say that you have to match the tax year of the benefit of that policy and the expense to when you claim it on your tax return. But we've got these safe harbor rules, which lets us take that entire $12,000 deduction for cash basis taxpayers right in the year when we pay it, 2025. And so that's how we kind of do it. We just have to make the payment. The payment can be in a couple of ways. One of those can be, cash, like, you do an ACH, you can do a credit card. So we'll talk about this in a second, but credit card payments are deductible when charged, not necessarily when you pay the credit card bill. And then lastly, you can also use a check. So imagine you actually, go into your bill pay and your bank, you issue the check as of 12/31. That is considered a deduction, even though your insurer hasn't necessarily received the check and cashed it yet, but you're considered having paid it, having written the check. So a few different ways you can do that. Sometimes you'll see, a greater deferral of that cash leaving your account. If you're going to do the check pay, a bill pay with, that's going to issue a paper check. But those are 3 ways you can do it, and you'll still actually, get that tax benefit. Always remember that the burden of proof is on you to prove that the payment was made as of 12/31, and also to support that the payment is related to no more than 12 months of expenses and it's related to just the next tax year. So like I said, if you're paying a 2026 expense in 2025, no portion of that payment could relate to tax year 2027. That extends beyond the 12-month rule that the IRS has laid out for us. And so that becomes, an ineligible expense for the safe harbor rule. So yeah, that's the important thing of it. Always remember too that if the payment you're prepaying is reportable on a 1099, that you go ahead and also issue that 1099 with that payment already recorded on there. So remember that. So the next thing to do is, this isn't so much necessarily a deduction, it's actually deferring our income, but one strategy you can do to reduce your taxable income for tax year 2025 is reduce reduce your billing to your customers, clients, patients, anything that you've got going on, just before year end. This assumes that you're a cash basis taxpayer, this strategy. So what ends up happening is customers, clients, and patients and insurance companies generally don't pay until they're billed. So not billing your customers or your patients or your clients is a strategy that business owners can use to avoid that income coming into the year. So if you don't bill them, then your customer doesn't pay, and therefore, as a potentially a cash basis taxpayer, you don't have the income to record in the 2025 tax year. So say you've got patients as say you're a dentist, right? And you have patients coming in for procedures that are maybe out-of-pocket procedures. And rather than billing them, before year end and then potentially paying, maybe you bill them after the year end and then pay the bill in 2026. And so therefore, that income that they might have paid before the year end, rather than it being in tax year 2025, it ends up in tax year 2026. So it's a pretty handy tool. Rather than it being a deduction, it's kind of avoiding income. So we do have different rules about what happens as far as what is considered income and when you've received payment. So that we have constructive receipt rules, which basically says maybe a customer sends you a check and you just don't cash it before the year end. Technically, we've got rules that say that when you receive the check, you're considered as being paid and it should be an income in that year. So you can't just avoid cashing checks to avoid the income. Technically, if you were audited and they could prove that that check was received prior to the year end and you just avoided cashing it, technically that could be an adjustment upon an audit. But in general, we're really just concerned about avoiding billing to avoid getting paid on the other side. So third option, so we've covered prepaying expenses, slowing your billing, making your receivables lag a little longer. And then third option, buying office equipment. So when you buy office equipment, there are a couple different deductions that allow you to, deduct those purchases. New and used personal property, such as machinery, equipment, computers, desks, furniture, chairs, all those sorts of things. You can deduct generally 100% of them in the year that it's purchased. So right up front, you just get the deduction, even though that piece of equipment will benefit you multiple tax years. And typically the IRS is going to tell you when and how long you have to record that benefit. We do have options via the Section 179 deduction and the bonus depreciation deduction under 168K, which lets us write off, claim a deduction and reduce our taxable income for those. A couple things to think about. One kind of note here is if you're going to qualify for the qualified business income deduction or Section 199A, the consequence is that it might actually go ahead and increase your expenses that may be eligible for a Section 199. It could actually reduce your Section 199A deduction. It just kind of depends on your facts and circumstances. So rather than increase, it would decrease the 199A deduction. So all of this is taken kind of, in tandem to think what would happen. So in general, though, the 199A deduction is a 20% deduction of the income. So if you take 100% deduction, you could lose. You only get maybe 80% of the benefit in reducing your taxable income just because you forego another deduction. But all of this really falls into the camp of it depends on your facts and circumstances, because there are all sorts of different thresholds that all interplay with each other. So we've had prepay expenses, we've had slow your billing to your customers, we've had buy office equipment. The fourth is going to be use your credit card to maximize the timing. So like I said, on the, with prepaying expenses, the day you charge a purchase to your business or a personal credit card is the day you deduct the expense if it's business related. So imagine you're a Schedule C taxpayer, you should consider using your credit card for last minute purchases of office supplies and other, business necessities. If you operate your business as a corporation and the corporation has a credit card in the corporate name, the same rule applies. The date of the charge is the date of the deduction for the corporation. If you are if you operate your business as a corporation and you are the personal owner of a credit card, the corporation must reimburse you if you want the corporation to realize the deduction, and that has to happen. And that happens the date of the reimbursement. Thus, you need to submit your expense report to the corporation and have your corporation make its reimbursements to you before, January 1 of before January 1, 2026. So you need if it's a corporation and it's a personal credit card, you need to have the corporation reimburse you for that amount before 2026. That's where it gets a little trickier, but yeah, you should be in good. It's definitely something that's workable. Everyone's favorite thing is talking about writing off their vehicle, and buying it at year end is one of the easiest ways to do that. So in general, I tend to just caution people about deducting their vehicles just because it's generally less business use than they realize, and there could be some tax traps in there. But if you are a person that does use your vehicle a lot for business, and you can actually substantiate that through mileage logs and all those sorts of things, this can be a good strategy. So if you buy your business vehicle before year end, you can create a big last minute deduction. This comes even if you buy it on a loan. And this can be because of the Section 179 and bonus depreciation rules. So the IRS allows you to deduct much or even all the cost of the vehicle placed in service by year end, but how you do it depends on the type of vehicle you purchase. So first, choose the right vehicle. So heavy SUVs, trucks, and vans with a gross vehicle weight rating over 6,000 pounds can qualify for up to a 100% Section 179 expensing deduction, which can have its own limitations, so just be conscientious of that. Passenger vehicles, which are under 6,000 pounds of gross vehicle weight, are considered luxury vehicles and face annual depreciation caps. So they typically are like deductible around $20,000 in the first year. It's not as big as a lot of people think it is if it's a passenger vehicle, which is kind of based on the weight of 6,000 pounds or less, or rather less than 6,000 pounds. And then fully electric vehicles may qualify for bonus depreciation and maybe clean vehicle credits. But it just kind of depends. A lot of those kind of went away with the one big beautiful bill. So just be conscientious of the rules, checking in before you think a deduction or a credit is going to happen on those items. Some policy changes did just happen. So first, choosing the right vehicle. Usually you want to have the gross vehicle weight over 6,000 pounds. Second, you have to have the placed in service requirement. So to claim that deduction in 2025, the vehicle must be purchased and placed in service, which is to say available for business use on or before December 31st, 2025. So simply ordering or financing it doesn't really count. The vehicle actually needs to be in possession and ready to be used. Next, you need to determine the business use of the asset. So for 100% deduction, you have to have 100% business use. So you can only deduct the portion of the vehicle used for business. If you only use it 75% for business, and say the 6,000 pound vehicle cost you 80,000, you only get to deduct 75% of the 80,000, which would be 6,000. So you have to maintain a contemporaneous mileage log to show business versus personal uses to defend the deduction if the IRS were to audit you. So that's the big thing that I find that people don't quite understand with deducting their vehicles is you don't have to keep the mileage log up to when you deduct the vehicle. You have to keep the mileage log over the life of a vehicle. And so that's the only way you're going to really make it through an IRS audit where they're focusing on your vehicle. So most people just don't have the capacity to maintain such records. So that's typically why I don't love it when people are trying to deduct vehicles unless they understand that rule very well and are very diligent about keeping their records. So these deductions occur because of the Section 179 and bonus depreciation rules that were previously mentioned. So Section 179 allows you to expense up to $2.5 million in qualifying equipment, which can include vehicles. That $2.5 million includes vehicles, equipment, machinery, furniture, all those sorts of things. And then once the gross value of all those purchases exceed the $4 million, then you start seeing that deduction phased out. Another option would be the 100% of the vehicle's cost in 2025 can be deductible under bonus depreciation under 168K. If it's acquired and placed in service after January 19th, 2025, you can use those bonus depreciation rules. And those can be helpful if you've maxed out Section 179. In many cases, using a combination of both can be helpful. When it comes to thinking about leasing versus buying, if you lease instead of buy, you can only deduct the business portion of the lease payments. However, you don't get the upfront write-off that comes with Section 179. So when we're doing this, thinking about deducting vehicles, keep a detailed set of records for the bill of sale and the financing agreement, the proof that the vehicle was placed in service by December 25th, and the mileage log. The reason that this is particularly effective at year end is, say you acquire this vehicle on December 27th, you have to show 100% business use from December 27th through December 31st. You can very easily manage that. And so that's why this can be particularly effective, is you can manage your use of that vehicle through the year end to get the result that you want. The last thing is the strategy 6 is going to be managing your qualified improvement property that may be deductible. So this is any improvement made by you to the interior portion of a building you own that is non-residential real property. Think office building, retail spaces, and shopping centers. If you place the improvement in service after the date of the building was placed in service. So this is a big deal because it's not considered real property that you depreciate over 39 years like you usually do with non-residential real property, or to say commercial business property. Qualified improvement property is 15-year property that can be deducted immediately using Section 179. You can use 100% bonus depreciation on it if it's placed in service and acquired after January 1, 2025. And then this also gets maker's depreciation, which is faster than straight line depreciation over 39 years. So again, to get this deduction, you need it to be placed in service on or before December 31st, 2025. So all of this is today when it comes to your taxes, business deductions are kind of king. And then you can also manage the income side by how you bill your customers. The more business deductions you claim, the less you're going to pay in regular taxes. And if you're self-employed, you'll pay less in self-employment taxes. And yes, paying less taxes is generally a good thing. It increases your after-tax benefit to your business activities. So here's a review of our 6 minute, our 6 last-minute tax deduction strategies. So one is going to be prepaying your 2025 expenses to reduce your taxes. Second, stop billing your customers, clients, and patients so quickly. 3, make significant equipment, machinery, and furniture purchases. Use your credit card to manage claiming that deduction before you actually pay it. Think about writing off a business vehicle at the end of the year. If you're able to show greater than 50% business use, that's totally possible. And being at year end, you can much more easily manage business versus personal use. And then for your 2025 qualified improvement property, make sure you place it in service on or before December 31st. So with that, I leave you with those ideas. And if you have any specific questions or ideas that you want to walk through, you're welcome to book a call using the link in the notes below. And other than that, I wish you all well, and I'll see you on the next video. Take care. Bye-bye.